computer. Recording. All right, here we go. We're live.
Live from New Hampshire,
Live
right?
from Seacoast, New Hampshire.
It's Talking Stocks.
It's Talking Stocks.
Yeah, no, Joe, this is awesome. It's always great to talk stocks with you and to go through some of this stuff. And I think we'll have a lot of fun just sort of sharing whatever we're seeing with our listeners and kind of going from there.
Yeah, it'll be cool down the road to get, some input from other people who are either listening or whether they're students of yours or, former students, former classmates of mine. So it'll be cool. I'm looking forward to it.
Oh yeah, it's been a while since I've done one of these podcasts and chatted with listeners and stuff. I've had some people request specifically on Twitter that, I try and get some content up there and share my thoughts in other ways other than just with 50 characters or, whatever they're limited to. I mean,
Right, exactly.
You like to do tweet threads, but you can only get so much information in those, right?
Yeah.
Yeah. It's funny because they always told me that, hey, I always talk in the class when we're talking about stocks and trying to figure out, how to figure out what stocks to invest in. I always say, hey, you got to have a thesis, right? And you got to be able to make it in an elevator pitch. Right?
Absolutely.
So Twitter's kind of the ultimate elevator pitch, right? If you can't get it in a certain number of sentences, forget about it.
240 characters. That probably takes about 30 seconds to read, right?
Right.
Yeah.
And I think it's pretty cool that we're talking to Joe at the time when the market's going through, a little bit of craziness, because I think that can be really helpful for people. And I know that, I've shared some information either through the service, Limelight Alpha, or through Twitter, and just some of the targets and things that I'm looking for. And I thought maybe that would be a great way for us to start is just, oh my God, this crazy week with the market, and, is this thing done yet?
Right. Yeah. It's funny. I had a friend of mine reach out to me, and she was just looking for, this was last week. She was just looking for some guidance on like what to kind of invest in, where to get going. And so I combined sort of my strategy and what you would always tell us in class, So I told her, first thing you should do is you should go and open up an IRA. And then the next thing you should do is just buy the index. Like if you don't want to manage it, just buy the SPY. And I did that myself back in, gosh, I don't know when, several months ago. And, I'm just going to sit on it, probably never sell it, maybe sell it when I'm like, 65 or something. And I'm already up 17%. So, it works. The strategy works.
Yeah. Slow money, consistent gains, right? It's like, hey, wait a minute, Joe, you didn't tell her to buy Snowflake,
No. I told her to avoid Snowflake and Nikola and those.
For most people too, Joe, I mean, that's going to be the magic is that the majority of your assets stay in that index, right? Because
right.
The index, as you're not going to get stuck in a stock that you forget about and it ends up going to zero, because eventually the index boots it out and replaces it with another stock. So, they say it's passive, but it's not necessarily passive. I mean, S&P, you have survivorship bias, right? Whatever is in the S&P over per time is changing. And I think a lot of people forget that, it's not as static maybe as some people think. I think, 70, 80% for the average person of their money in something like an S&P index fund, or even better, S&P ETF, because if you have access to ETFs, because they're usually have lower management fees. Makes a lot of sense. And then you can sprinkle in the crazy ideas on the side that could really, help you. Yeah. But at worst case won't kill you.
Yeah. One of the things that I notice with a lot of people my age is that they'll invest in companies that they like, but they're almost doing it for the wrong reason. Like they'll invest because they buy their products, like, Nike, for example, or Apple, and, they think that they make a good product, when in reality, they should be, looking at kind of more like what you always talk about, kind of the thesis, what are the underlying numbers. And so I always like whenever somebody asks me a question about, what should I be investing in, I always kind of like, I always kind of shy away from, you know, having them invest in high risk, like kind of Tesla like stuff. Like, yeah, of course, Tesla's a really appealing investment, and, you know, high growth, and what they've done over the past year or two has been staggering. But is that going to pay off in the long term? Yeah, maybe, but it's a really high risk.
Yeah, and I think people have to kind of come to terms with whatever their own style is, right? I mean, we all have kind of like this default style, and you kind of have to find the investing strategy that matches your default style. You know, somebody who's a bargain hunter, you know, is not going to be very excited about or feel very good about going on buy Tesla. They buy Tesla and it goes against everything that their body is telling them to do. They're going to have a lot of sleepless nights.
Absolutely.
Where someone who's more aggressive or has more aggressive personality or is more interested in growth, maybe more interested in growth stocks. And, you know, that's something where I land typically, you know. But I think the other thing too, I mean, as we saw this craziness with Nikola. I don't know if you followed that stock. It's kind of like a Tesla wannabe.
Yeah.
It has been in the news a lot lately. You know, they don't actually have anything in production yet. So I think a lot of people were looking at something like that and saying, oh, you know, electric vehicles, they're going to be great. Oh, hydrogen fuel cells, yay, whatever. And going out and buying that. And that was the limit of their due diligence, you know. And I think that it's a good starting point to say, hey, I like Nike's product, right? And you might remember we did this in the class too. You know, what kind of products do you like? What kind of services do you enjoy? What kind of
exactly
things do you like? You know? And I think that's a great starting point. But like to your point, you know, your thesis needs to be better than, you know, I happen to buy their shoes. You know, I mean, you have to have an understanding of what their addressable market is. You have to understand about what their, you know, we do this pestle analysis that we'll talk about, I'm sure, in a future show, but try to figure out what the risks are that are facing the company and how they can overcome them. You know, you want to be able to communicate the stock that you pick. If you're not going to do an index, you're going to be able to, the stock that you pick within a 20 to 30 second window, elevator ride, if you will. And to do that, you need to do enough due diligence to, you know, be able to break that down. It's a lot harder to get something small than it is to get something big, right? So you have to have all this information then condensed down into something small that you can share and people can go like, oh yeah, that makes sense.
Yeah, and probably even more importantly for, you know, young upcoming investors who, you know, might only have a couple grand in the bank, like your thesis can't be the kind of Robin Hood effect, like, oh, everybody else is buying it, so I guess I should too. You know, that's how people on, like, you see screenshots of people on Reddit who have lost 99.98% of their Robinhood portfolio, and that's exactly why that happens. Is because they're foolishly trading. They're trading options that they don't know anything about, and they go in very ignorantly.
Yeah, playing with fire, really. Hey, you might get lucky, right? And I think that's the worst thing that could happen, right? Is if you get lucky out of the gate doing that kind of thing, because then it gives you that false feeling of, oh, I got this thing figured out. Trust me, Mark's been around a lot longer than you. You're not going to figure something out in your first couple of trades and all of a sudden be a guru. It's just, you know, the market will make you pay tuition at some point in time. And, you know, it's really just, you know, you're playing with fire with each time that you're not doing your due diligence and you're not, you know, following whatever your risk control is and whatever your system is. I mean, you're right, Joe. I mean, you have to have a systematic approach to investing, you know, and then when you start with a systematic approach, then you can have these rules that govern, you know, what you do. And that removes, or at least reduces, right, the emotion, because emotion is so deadly, it's so dangerous.
Absolutely. Yeah, it's tough to, sometimes it's tough too, because you have a stock in your portfolio, perhaps several that are winning really strongly, and so you have to kind of balance, like, oh, this is doing really well, and so you have to kind of keep your ego in check and know, you know, when you want to sell, what's your long-term strategy, what's your long-term goal, like as you said so many times in our class in the spring, let your winners win. And right. So sometimes I'll look at my portfolio and I'll have a stock that's up, you know, 30%, and sometimes that'll be I've only owned it for a month, owned it very short term, and so sometimes I'm like, yeah, maybe I do want to sell it. But then I kind of come back to that and I hesitate a little bit. Like, is my thesis broken? Is my the initial reason why I bought the stock, is that reason still valid? And if it is, then most of the time I hold it.
Yeah, that's so smart, right? Because I mean, is your thesis intact? Is your catalyst broken or not? You know, if the stock is falling 10 or 20% and your thesis and catalyst is intact, it sucks that you're down 10 or 20%. But I mean, you know, you bought it for a reason. So, you know, let that reason play out.
Totally.
Different story though, right, Joe? If your thesis is busted
Oh yeah.
and your stock is down 10, because then you get into hope and prayer method of investing, which is never where you want to be.
Yeah. I certainly have some kind of mistakes in my portfolio that I'm like, I've been trying to decide for months now whether or not to cut my losses. And for some of them I have, but for most of them I have not, because, I don't necessarily need the money in the short term. And so maybe it'll turn around. One example is like Boeing, which I bought a couple years ago now, maybe 3 years ago, and had a thesis like, yeah, they're a great company, they pay a solid dividend, and then of course everything happened, and I did some pretty extensive research in our class in the spring and kind of cemented my opinion on them, and then they dipped even further during the pandemic, and now I'm kind of looking like, is whatever price they're at right now, 156, is that really a fair value? Personally, I don't think so. I think they're worth more than that. And so I'm kind of just waiting now for that to get back up to a point where I've broken even.
Yeah, and the only caution that I would throw out there, and a lot of people make it, that you're doing the homework, they're coming up with a reason why you think that it should you should hold on to it. Just be careful of anchoring bias. That concept of okay, a past price, and I'm anchored to that past price, and that's affecting me more, or the amount of loss or the amount of gain is affecting my decision more than actual logic is, right?
Absolutely.
I mean, don't sell a stock just because you're up 50%. Don't sell a stock just because you're down 50%, right? Instead, focus on the business itself and whether or not you think that the business justifies being in the stock. Because oftentimes, I mean, Joe, we there's thousands of stocks out there we can own, right? But we don't have unlimited money. So, at some point you've got to do this prudent pruning of your portfolio, right?
Absolutely.
Pruning of your portfolio that frees up some cash, and then you can take that cash and you can deploy it into whatever your next best idea is. I don't know if I've ever made this comment to you, but I like to think of myself as a opportunistic long-term investor.
Yep.
Meaning that I'm buying with the thinking that I'm going to hold on to forever. But if our overbought indicator, for example, starts flashing massive warning signs like it started to do in August, then yeah, I'm going to rein in some of my exposure, raise some cash, and then redeploy that cash like I have been in the last week or so, starting to redeploy that cash. I think I've taken my cash down from 25% to probably closer to 15%, maybe 12%. And I'm going to continue to do that over the course of the next week or two, because my feeling now is that the S&P, I'm not a technician, but I will look at technicals to help guide me at these points when it comes to the market. My current feeling is that, if we can hold somewhere in that 3,200 to 3,400 range and sort of bounce around in the range bound, I think that overbought indicator will normalize, because what the overbought indicator does is it measures the percentage of stocks that are trading more than 5% above their 200-day moving average, right? So if the trend is up, right, the 200-day moving average is trending up. So if you start to go sideways, by definition, at some point, you're going to start to normalize that overbought reading. So you don't need to have an additional dramatic sell-off, I think, in stocks to get that back down to, say, like a 20 to 40% reading. Right now, we're at 55% mid-August. We're at 49% now. I'd like to see it 20 to 40%. But again, you don't need to have that big drop. It can also just happen, be normalized by some sideways action. And that's kind of how I'm banking right now, is that, we're going to go sideways for a little bit, use those to your advantage, the down days to your advantage, to kind of get those new leader stocks in, and then see if we can bust up from there and put in some new highs. We'll see.
Yeah, time will tell. It's kind of, the past, I guess it's 6 months now since we really kind of descended into this new pandemic world. It's been very just impossible to predict what the market's going to do, because since then it seems like the most stocks have been just completely unreflective of the company's performance and kind of financial situation in real life, so to speak. And
Yeah, like
it's just
why,
being
why
driven
is
more and
Carnival
more.
Cruise Lines up when they're not even ships not even in the water?
Exactly. The
Why are
latest one
restaurants
is the latest one is GameStop, and they're up like, I don't even know how much, like 300% now in the past month or so. And why exactly? No one really knows. It's
Yeah,
like
well,
it's
what's
the Robin
interesting,
Hood effect.
yeah, GameStop is an interesting story because GameStop actually popped up in the research about 3 weeks ago,
Yeah.
and I was shaking my head, like, wait a minute, why is this thing popping up? And it was, and sure enough, it turned out that there was an activist investor building a position. And this activist investor was actually one of the co-founders of Chewy, which obviously is a very
Oh, interesting.
successful e-commerce play um, in the pet space. No longer, I don't think he's involved with Chewy anymore. I think they sold it out to Petco, his share to Petco. I could be wrong. He may still be on the board. I'm not sure. I'd have to go look. But anyways, the fact that you have this person who, obviously had some success in building out an e-commerce brand, and they're building up, exposure to GameStop, and then maybe saying, okay, well, can we pivot somehow GameStop to a, more of an e-commerce oriented brand? And then it's not lost on me either, and it may not be lost on you for the gamers in your life. I mean, this is a big console launch season,
Right,
so
exactly.
yeah, I mean, so
The
who knows how that's going to play out? I mean, that could drive a lot of business to those whatever stores they do end up opening, as COVID allowing.
Yeah, the interesting the thing that I'm like struggling to get over is that the whole kind of gaming industry is shifting more and more to downloads rather than the physical game. And if I'm not mistaken, the new generation Xbox is going to be download only. And so, what the heck does GameStop do in that scenario? Because the games are just being directly sold by Microsoft through an e-commerce platform. So to see GameStop, they were up like, at one point I looked yesterday, they were up like 22% intraday. And it's like, it makes absolutely no sense given like their not so distant future of having to completely pivot away from brick and mortar retail.
Exactly. I mean, you just nailed the bear thesis right there. It's like, I mean, that's why, the stock's up 300% because, I think, some ungodly amount of the float was held short because of that
Yeah,
exact thesis, which is that, this thing is a dead man walking in a way. It's just a matter of time before, you get this direct to consumer thing that happens that just unravels their business model. Who knows, right? I mean, that's what makes a market. I guess we'll just have to keep tabs on it. I don't own it. I don't own GameStop, but
yeah,
I am extremely curious to see how this plays out from here.
yeah. I don't short stocks because I'm not rich enough, and two, I don't really like to gamble. But if I could, I think I would probably consider shorting it. It's
Wait a minute,
just, if I feel like it's just a ticking
profit,
time
right? I
bomb.
mean, don't you have to short? No, no, right, exactly. No, do
Yeah,
not short. Do not short. Unlimited risk if you're wrong. Unlimited risk.
absolutely.
If you're wrong. I'd rather own cash. I don't. People talk about hedging. Hedging. Well, you can hedge wrong both ways. So
Yeah,
your longs can be wrong and your shorts could be wrong. I don't know. In my experience, I've just found that if I'm nervous about the market or I'm nervous about stock, sell the stock and hold the cash until you find an idea you like.
yeah. That's smart, and I've certainly done that a little bit as I kind of shift things around in my portfolio. Focusing on less of the kind of quick money and more of the long-term growth potential.
Yeah. So Joe, did you were you paying attention at all when Snowflake did IPO? I mean, we had this huge IPO calendar this past week.
I was, yeah, because the Limelight Twitter feed, all of the accounts that I follow on there, it was just they were just all talking about it. And Friday morning, I was like, what the hell is Snowflake? and then
It sounds
and
like
then
some sort of political thing, right?
yeah, and then yeah, exactly. The only time I had heard Snowflake in the news was like when some, conservative pundit had said it and gotten in trouble for it. And
It's either that or you're looking out the window. Yeah, does it have something to do with snow removal?
exactly. So yeah, I looked at that and it was like, oh yeah, here comes the Robin Hood effect all over again.
Yeah, I mean, one of the things with IPOs like that is that you get the hype machine gets going, and just like a little inside baseball kind of commentary on that. When they do the roadshow and they're placing all these shares with the institutional investors, a lot of these institutional investors, are not going to hold on to the shares. They're just thinking, hey, I can flip this over to the retail investor once it goes public. If it pops. So, you get a Snowflake goes public, it doubles the first day because, the average retail investor couldn't get involved in it. So they're like, oh, I got to buy it at any price, right? Well, at the same time, you get the smart money, those institutions who are like, yeah, you can buy mine. You can buy mine at a nice in a day, take it. So, I mean, I think that, just to work from my perspective, if you've got a big account, sometimes you can get the IPO price through your broker. Fidelity allows that for certain accounts if you have a certain size. Sometimes you have to opt into it on your brokerage site. That's one way you could do that. That's probably the better way if you've done your due diligence, right? And look at the S-1 filing and actually understand the business a little bit, God forbid, right? Understand the business. And then you can get that IPO price, and then you can decide if you want to sell it to the quote unquote dumb money, the retail investor, when he's showing up or she is showing up to buy it on that first day. That's one way to do it. But I mean, for most investors, buying IPOs historically on the IPO day or right after the IPO, it's not the best move.
Yeah.
Usually these stocks will just be just too risky to own until they've got a few quarters of success behind them. And, my personal opinion is that in 90%, so 9 out of 10 cases, you're better to wait 10 months, 6 to 10 months, something like that. Because you also have to remember the insiders, a lot of them, they may get paid okay, but they're paper millionaires, right? Well, they want to convert that into being real millionaires, So you have to wait until that lockup period expires where they're allowed to actually sell on the open market too. And, usually that's like, I think it's 6 to 10 months. I can't remember the exact number of months for the lockup period, but you Google lockup period plus the IPO stock, it'll pop up.
Yeah.
And then when that's done and you've got a few quarters, then you can step in and you can say, yeah, I'd like to own some of this. Because I think everybody will think, oh, if I don't get it at the IPO price, I can't make money, which is bull, right?
Right.
I didn't buy Tesla at the IPO price. I bought it late, quote unquote, and I'm still up almost 1,000% on it. So I mean, you don't have to worry less about getting the IPO and worry more about understanding the business and finding a good entry point.
Yeah, there are lots of different ways to make money, and oftentimes, like if they have a very poor earnings release at the beginning, then you see just a massive sell-off, and so the chart starts to look like this, and then it goes like this, and it's almost an instant sell-off after the big kind of buying spree, because people realize, oh my God, this price is way too high.
Yeah,
Cryptocurrency does the exact same thing.
It's like a chairlift at your favorite ski resort, right, Joe? You go up, and then all of a sudden you get to the top, you start skiing, and it goes straight up.
Yeah, and you ski down really fast. That's the thing.
Yeah, always goes down. Market always goes down faster than it goes up.
Yeah.
It's funny. I'm reading a book right now called Misbehaving, and just an excellent book about behavioral economics, and highly recommend it. Anyways, one of the things they talk about is just how much more pain hurts. How much more pain is inflicted by losses than gains is kind of the takeaway from an investing standpoint. Like you will feel way worse about a stock that falls 10% than you'll feel great about a stock that rises 10%, and way worse if it falls 20%. So I think that as investors, we got to be cognizant of that.
Yeah, because people kind of expect to make money in the stock market, and they don't expect to lose money.
Right, and I mean and if you invest kind of on a knee jerk, or you think that what's that, read your press clippings too much or whatever. You think that you've got it all figured out, and you've invested mentally a lot of yourself into those decisions. So then it becomes not just I was wrong about the stock, or the stock is losing me money. It's like I personally was wrong about this stock, and then it becomes even a greater emotional, weight to try and carry around and figure out what to do with. You just have to be much more objective, sitting up here and playing with the marionette strings, and just worry less about what your ego might have to do with it.
Right. Yeah, that's a very good point. Yeah. So I'm just looking and seeing if we missed anything big from the kind of last week or so. So we got into the Snowflake IPO. The one thing that's kind of looming on my mind is just kind of generally like the market index, the overall market. Like, I'm interested to hear your perspective on where the, like, what the short-term outlook is, because we're still a little bit below the kind of moving average on the SPY. We haven't made up that correction yet that began kind of at the beginning of the month. So obviously there's so much uncertainty with the political situation. I think is probably the biggest factor, but other things too. And so I'm interested to hear what you kind of think the next month or so might entail. And that might be multiple potential outcomes, right?
Yeah, well, absolutely. And I think a lot of people the media is going to make a lot of the election over the course of the next 6 weeks. You're going to have debates, you're going to have pundits coming out saying this, that, and everything else. Everybody's going to be making projections. The market goes down, it'll be blamed on the election. The market goes up, it'll be blamed on the election, right? It's going to be basically the bugaboo in the room, if you will. And I think that, what investors need to take a step back and remember a few different things, right? Historically speaking, over time, right? The third and fourth year of a presidential cycle are the best. And the first and second year are not as strong as the third and fourth year. Doesn't mean they'll be weak, doesn't mean they'll be down or whatever, or it doesn't mean there are exceptions. But generally speaking, we're in that sweet spot, 2019, 2020, when markets should do really well.
Yep.
And I think we're seeing that. And I think that, tempering a little bit of your enthusiasm going into next year, regardless of who wins, might be a little bit wise, just because naturally speaking, you do get that kind of weakness in the first couple of years, or at least not as strong as the other 2 years. And I think that makes sense to people intuitively, right? Because you go in and you get elected and you're like, okay, let's put all these policies in place, and you've got change, and then change creates uncertainty, so that can make the market do weird things. And then in the final 2 years, you're starting to think, okay, I need to get reelected. So, you start doing things to try and prop up the economy, you try and stabilize things, you try and increase clarity so that people understand what's happening. So I think intuitively that makes sense. So, I think I would be cautious of people putting too much weight on any action that happens over the course of the next 6 weeks. Because that kind of short-term thinking may distract you and cause you to, sell something you really shouldn't have sold, or buy something you really shouldn't have bought, right? But if we're going through and we're just doing, our homework, and, we're coming up with, intelligent stocks to own, then I think that, the best way to approach that is just opportunistically. If we're going to be bouncing around because of the noise and the media and everything else, then, hey, I'll use those down days to increase exposure. I'm going to share my screen, Joe.
Sure.
So, hey, if you're watching this video, great. I'll try and talk you through it if you're just on a podcast. But I'm actually going to pull up the screen right now of I use MarketSmith as one of my charting services, because I think that they do an excellent job. But you'll be able to pull it up on your own at home, of the S&P 500. And one of the things I think is interesting when you're looking at the S&P 500, and I just pulled up the SPY on this chart so people can see it. But you can see how you had this nice big peak, but it was peaking on volume that was a little bit below average. Now remember too, volumes. If you're looking at average volumes, and I like to look at average volumes because I think that can kind of be a good clue to whether or not something's durable or not, a move's durable or not. But remember, the average is going to be influenced by all that huge volume that we had back in March,
Yep.
So it's not, it's not abnormal to have lower volume, right? You did have these sell volume, big sell days here, that was kind of your signal to say, oh, I guess people are interested in getting out and raising some cash. This was, by the way, after we gave our warning in the service because of the overbought signal. So hopefully our members were able to raise a little bit of cash ahead of that and then take advantage of it as it's come down. I had originally been looking for 3,300, a break below, and then maybe like an intraday reversal sometime somewhere in that 3,200 to 3,300 range. And I think if you look at this chart, this right here was a little bit of a head fake, as it held support at the 50-day moving average. And then they rolled it again on accelerating volume, right? So that's a little bit concerning, right? But then you've got below that 3,300, and I think 3,270. If you're looking at the S&P 500 numbers, not the SPY numbers, but right around 3,270 was where it stopped moving. But if you look at the SPY here, you see there's a pretty good line of support here, 320s to 330 range. So my personal opinion is that put a little bit of money to work here and expect that we could bounce around a little bit in this range. But as long as we turn up anywhere in here, I think that we'll be okay. And in that way, it kind of reminds me a little bit of, 2018 when we peaked in February and rolled over, pulled back to about the 200-day, and then started another leg up in the rally. And I'm more modeling that, Joe, right now than I am modeling for, oh my word, we're going to head all the way back to these March lows. I mean, obviously, subject to change, data dependent, right? But
yeah.
I mean, that's kind of how I'm approaching the market now. So, I went out and just to share with you some of the highest scoring stocks that I picked up from our research recently. And these are all names that scored over the course of the last, 4 to 8 weeks or so, relatively high. So I added them to my watch list. But one of them that I bought was Wingstop. I picked up some shares of Wingstop on this drop. And, you got a company that's growing 36% year over year, despite COVID. It was a business.
It's remarkable.
Yeah. Joe, if you've got a company that's executing well before COVID and they're still executing well with COVID, that's a pretty good sign, right?
Yeah, especially for a restaurant.
Yeah, exactly. That and Domino's is what I'm watching right now, but I haven't pulled the trigger on. I wish I had earlier.
Yeah, that's one of the top stocks this week, right?
Yeah, one of the top stocks
scoring
this week. It just jumped up into the list this week as a good spot to be a buyer of it. And you can see it's going to flirt with that prior highs again, it looks like. So, if it busts out above this, you've got a great base to build off of. And again, I'm not a technician, but I'm looking at this and I'm saying, hey, you've got a company that's growing double digits despite COVID. If you look at down here, 13% year over year growth in the most recent quarter. If you look up here, their earnings per share in 19 are going up to 2020 to going up to 2021. And those estimates are being revised upward. So you've got a company that theoretically could see both revenue holds solid at the double-digit growth range and earnings escalate. And stocks follow earnings over time. So, people will, why the market down? Market up when the economy, GDP is down. Well, it's because people are already modeling for an expansion off of year-over-year expansion in revenue and earnings off of really low numbers that we generated early this year.
Yeah. So, it's important. It's important for people to remember that the stock's price is kind of, some of it is inherently based off of the company's growth potential. Like Tesla's a great example of that, right? Like, how the heck can Tesla be worth more than all the other car companies in the world? How are they worth more than Toyota? It's because, they have the potential to be much bigger than Toyota in 10 years, maybe 5 years, if they're really good at what they do. So yeah, that's definitely an important lesson for kind of the amateur investor, like myself, admittedly.
It's interesting, and I heard a stat this morning when I was watching TV. The EVs, electronic vehicles, only represent about 2% of market share of all vehicles sold.
Yeah.
And Tesla represents about a quarter of that 2%. So you start thinking about, wow, the story's over. Theoretically, they could sell a lot more cars from now, and that obviously doesn't even take in consideration potential in energy generation or anything like that.
Right.
Another stock, just, go back to some of the ones I've been picking up in the past week or so. High scoring stock from our research is Coupa Software. I think that's creating a pretty nice entry point here as well.
Looks like it, yeah.
Yeah, you get that 32% year over growth again. You've got a chance for earnings acceleration through 2022. And if you think about it, what they do is they do software for procurement. Companies need better tools in their toolbox to manage how they're spending money to buy things.
Right.
And, especially big companies. Big companies have so many pain points when it comes to acquiring supplies and products from vendors. And Coupa helps solve those. So I think that was an interesting entry point for that stock. And then just, one last one to mention that was a high scoring stock that I picked up some shares in was Lululemon.
Yep.
Same exact thing. You've got, Nike came out today, right? Reported huge numbers, right? Lululemon, not as successful as Nike in the most recent quarter, but still, for a retailer to actually grow 2% year over year, that's pretty darn good.
Yeah.
And if you look at their earnings trend, 384 in 19, going all the way up to over $6, maybe $6.40 in 2022. And I bought it, peaked at 400, and my cost is down here closer to around 300. So I felt like that was a pretty good point to give that one a shot. So I think there are some stocks that are, make sense to put in portfolios, and if you've done your homework ahead of time, like all of these, Joe, were names again that I added to the watch list previous to the decline. And all of them, when I started getting nervous about a decline, I actually set target prices that I wanted to buy at.
Yep.
And I did that because I didn't want to get emotional. I didn't want to react. I was like, okay, if I see my price that I want to pay, great. If I don't, oh well.
Right. Yeah, you can't. Yeah, when you make a plan like that, you definitely need to stick to it, assuming that when you made the plan, it wasn't a kind of panicked reaction. It wasn't a knee jerk, as you said before. So yeah, it's definitely important.
It's way easier to think straight and make these plans when the market's good.
Right.
Your decision making is just going to be so much better if you think ahead.
It was a lot easier to make plans and trade plans in 2019.
Exactly. And to feel good that you're how smart you were for those plans, right?
Exactly. Yeah, it's funny. In one of my classes yesterday, we're working on doing some statistical modeling and forecasting, and so just for kicks and giggles, I decided to use some data, and so I used the stock price of Visa, which I've owned for a couple years now, and I calculated the error in kind of a couple of just traditional forecasting models that are pretty basic. And overall, I went 10 months back, which brought me to December 2019. The overall error was remarkably low. It was 0.2%, but it was because there were some months where the statistical model predicted it was 20%. It would be 20% higher than it actually was, and then there were some months where it predicted it would be 20% lower than it actually was. And so yeah, it balanced out. But it's like saying that a seesaw balances out eventually. It doesn't really work like that in reality.
How many sleepless nights and over that period of time, right? Highs
Oh my
and lows.
gosh, yeah, for sure.
Awesome. Well, listen,
All right.
Joe, it was great talking to you today. Hopefully we'll do this more often.
For sure.
And hopefully our listeners, hopefully they enjoyed it. Maybe they can let us know.
Yeah, absolutely. If anybody listening, if you have questions that you want us to answer in the coming weeks when we do this again, please reach out. Limelight Alpha on Twitter. You can reach out to Todd EB Capital on Twitter. Leave a comment. Send us a message. However you feel, however you want to. All right, and with that, signing off.